What's up, everyone? My name's Robbie. This is Robbie and Manila, and today we're talking about why your index funds and your ETFs just aren't performing well this year. If you're like 99% of people who are investing right now in this market in 2022 in these crazy conditions, you're very likely experiencing a drought in, let's say, good performance inside any of the ETFs that you own. Now, this chart really just puts 2022 into perspective. It's a heat map of year-to-date returns of different sectors. Now, these are showing returns from this year, so start of January until where we are right now when I'm recording this video. Look how much red is in this chart. Now, in any bull market, even any mixed market, you're going to see a decent amount of green and some red usually. And right now, it's just red. Obviously, there are some little pieces of green in here, which we're going to go over, but for the most part, this looks absolutely abysmal. We're talking the major US indices. We're talking about large caps, mid caps, small cap ETFs. We're talking about commodity ETFs. We're talking about international ETFs, Europe, Asia, global ex-US. Fixed income getting crushed as well. Corporates are getting crushed, and different strategies are also getting crushed. There is one area of the market that is doing relatively okay, and that is the energy sector. And yes, also this part of the heat map is green, but these are inverse ETFs. So these are showing ETFs that gain when the market goes down. So obviously, these are good when we're in a bear market. So anyway, in general, pretty much everything is red. Pretty much everything that you probably own is not doing well this year. Some things, especially if you just got started, let's say, investing in 2020 or kind of in, let's say, the recent 5 years, you might even be negative for how much you've gained total during your investment career. And now this tweet from Eric Balchunas I think it really encompasses what's going on right now and the way you probably feel about investing in the market and your ETFs and your index funds. And so this is a reply to Ben Carlson, who is a great blogger. He's a great YouTuber. A Wealth of Common Sense is his website. And so you got me curious. Did a quick search. Only 6% of 27,000 ETFs have done better than inflation over the past year. It's basically all energy/commodity ETFs with a few exceptions, such as the cash cow ETF, utilities, and a couple alt ETFs. Pretty bleak though. And you got to remember, the only way to really invest and grow wealth is to outperform inflation. If you're not able to outpace the growth of inflation over your lifetime investing, you're actually going to lose money on a relative basis. And so what we all are trying to do here is we're trying to build wealth and we're trying to make more money relative to inflation. We want to make more money than inflation is so that we can actually grow wealth and not just grow our bank account, but actually lose money based on inflation. And so this is really just making it tough for a lot of people out there to stomach, to understand that right now, things are not that great in the market. And of course, they're going to get better at some point in time, but it is hard to kind of stomach what's going on right now when you look at your ETFs and you see that only 6% of ETFs, when he wrote that, are actually above inflation. And if inflation's around like 8%. And if you feel bad, remember, 6% of ETFs are actually doing better than inflation. Now, think of how many people who invest in ETFs are actually investing in only those 6% of ETFs. They are likely not just in those ETFs. For example, if we go back to this heat map, we can see that the XLE ETF, XOP, ERX, these are different energy ETFs. These ETFs are up a lot. But most people are not putting all of their money inside of an energy ETF. They're not going to just put it into one sector. They're going to have a diversified portfolio. Maybe they'll overweight what they're putting into a sector like energy, for example, but they're not going to put all their money into this. And so at the end of the day, if they have 10% of energy, if they have 15% of energy, if they have 20% of energy, but the rest is in these other ETFs, if the rest are in financials, down 18.36% for XLF. Technology, if you're in VGT, you're down 28.51%. If you're in consumer cyclicals, if you're in XHB, you're down 34%. So all of these different areas, if you had ETFs that had exposure to any other parts of the sector, you likely are not doing that good this year. Even if you had decent exposure to energy, you're probably not significantly beating the general market. Now, if you are near investing in ETFs, I applaud you. I don't know what you did, but leave a little comment below. Let me know how you did it. I would love to know. I'd love to hear from you. But just know that most people, almost everyone that you're going to talk to probably, who are investing in ETFs and a diversified portfolio of ETFs, they are not doing well this year. And according to that tweet before, they're not being inflation over the past 1 year period as well. Now, just when you thought things weren't getting too hard and you're like, hey, I'm just going to go invest in some energy ETFs and I'm going to do well, look how much outflows there have been from energy ETFs and materials ETFs. So those two parts of the sector, it's the largest outflow ever from resources. So energy from materials. This is from Mike Zaccardi on Twitter. He tweeted this thing out. And so this little red area is the combined materials and energy outflow. So people are now taking money out of energy and have materials. And so if you thought that was a safe place, maybe it's not. I mean, I have a decent amount of exposure to energy, but I do think that long-term energy is going to be okay. So I'm actually okay with what I'm doing right now, but there is something maybe to be considered here. Outflows are huge from energy and materials right now. Now, I don't want to get all doom and gloom here. I want to show you something that I think is important. This is from FI Mindset, and this is a nice little visualization I think that we should think about here. So comparison is the thief of joy. So if you're really comparing your performance this year to other people, then you might have a few people that you're going to talk to that are doing well, and it's going to make you feel bad. Don't do that. Don't do that. Now, I hope that you're not invested in like all tech stocks and ARK and just like tons of really risky stocks that are, or ETFs and stocks and index funds that are down more than like 30, 40, 50%, because I know there are people out there who have been doing that. And if that's what you've done, then I'm sorry to hear that you probably are underperforming a lot of people. However, when you compare the rates of return that you've had, just remember that those people may be lucky. They may be taking more risk. They may be overexposed to some places, and that doesn't mean that they're necessarily doing what they should be doing. Now, this is exactly what happened in the past couple years, leading up to 2022. Every single person you were probably talking to who were investing in the stock market, and every single YouTuber was talking about these tech stocks that had no basically cash flows. They weren't making money. They had negative earnings. They're burning through cash like crazy. And they are making crazy gains in their stock prices. And you're sitting there and you're investing in your conservative, let's say Bank of America, JP Morgan, Johnson & Johnson, right? So you're investing in these conservative companies and they're like going nowhere compared to companies like Zoom, to companies like Peloton, right? So these companies are just killing it, and you're just sitting here and you're comparing yourself to these other people. Don't do that. Try to invest with a diversified portfolio of a diversified amount of stocks. Don't just go all into really risky tech stocks. Don't go all into semiconductor companies, right? And by the way, this is why you don't want to do that. And we can see here in this tweet from QF Research, this is saying South Korea's chip stockpiles increased by the most in more than 4 years. And so we're talking about here are semiconductor chips, right? And so the year-over-year spike in chip inventory in 2018, so essentially what happened was stockpiles of chips increased, right? So suddenly there's all this inventory of chips. And why is that? It's because suddenly demand isn't there. So the computer that I have right now, I have a NVIDIA chip in this computer. If I'm not going out and buying a new computer because of the economy, suddenly this chip isn't going to be used, right? Same thing, let's say if you have cars, devices, right? So when spending slows down and there's lots of electronics right now that are being bought in this type of economy, so too do these semiconductors. Now in 2018, when this happened, it peaked up here in the, let's say, 50% area. Now we're actually above that right now. And so essentially what this is saying is that we have a much higher shortage of chips right now, which is definitely not good for the idea of, let's say, if we're maybe going to be in a recession. Now I kind of bring this up to kind of just show you what's going on with semiconductors. It's one of those areas that if you had still invested back in 2019, you are still up. You have done very well if you invested in semis, but right now, I don't know what's going to happen with a sector like this, right? Or an industry like this. So semis, NVIDIA, for example, I don't know if NVIDIA is going to suddenly start being really affected if there are chips that are not being sold. If there are lots of inventory laying around and suddenly NVIDIA's earnings get hit and suddenly the growth prospects of NVIDIA go down, and so maybe then the stock continues to go further and further and comes more towards what you would call equilibrium, or not equilibrium, but let's say reversion to the mean. Meaning that stocks should essentially all trade over the long term according to their earnings. And so stocks that trade at crazy multiples for too long will eventually revert to the mean. And so what I'm wondering is, companies like NVIDIA as well, are they starting to revert to the mean? And so if you're invested in semiconductor ETFs as well, and they've done pretty decent over the past multiple years, I don't know, maybe that is also an area where it might not be looking so well. At least in the short term, if we do end up in a recession, that's my thinking. Now there is hope here. If you take a look at this chart tweeted out by Walter Deemer, who actually is saying that this is kind of crazy and it's probably not realistic, but these are the price targets that are going on right now for the S&P 500 for the end of this year. Now you have the opening forecast of the S&P 500, so this is basically saying Bank of America, for example, said at the start of this year that the S&P 500 was going to be 4,600. Now as of when I'm recording this, around 3,800. So obviously it's got a lot to go to get to this level, but they revised this. This was S&P 500 forecast for the year end. This was as of March 31st. Now they only lowered it to about 4,500. So Bank of America actually is pretty bullish on what's going on. They think this next part of the year is going to be very good for the stock market. You take a look at Barclays BMO, right? And so BMO has 4,800 target, right? And so when you look here, there are a lot of companies that have revised in around June period that are actually still pretty decently high. None of these really have a lower price than we are right now. So pretty much everyone thinks that we're going to have a better outcome than we are right now. The average forecast is 4,482. Remember, it's 3,800 right now when I'm recording this video, so that's good upside. Now here's kind of what I think is going on. The analysts have not yet revised earnings downward for a lot of companies because a lot of companies have not guided that yet. And so let's kind of put this in perspective using like a PE ratio, which I think a lot of you probably understand, know what it is at least. So let's say these people are saying, we think that by the end of this year, we're going to snap on basically a price-to-earnings ratio of the market of, let's say, 18, for example. I'm just making this up. Let's say it's 18, so you have a PE of 18. So you have the P and you have the E part of the PE ratio. So you have the price part and you have the earnings, and you get a multiple out of that. So we've seen multiple compression so far. So these analysts, they were giving probably higher multiples to the S&P 500. Let's say they were giving it 20 or 22, right? Now let's say they're giving it 18. I'm just, again, making these numbers up to just tell you multiple compression from 22 to 20 to 18. The other thing that they haven't really changed yet is the earnings part of this. So the earnings part of this is the other part that's pretty important. So the earnings part is what they think the companies will be earning for this year. If we are in a downturn, like we saw, semiconductors, that's not good for semiconductor sales. That would say to me that potentially semiconductor companies, they're going to have shrinking earnings. They're going to have to guide lower, and the analysts are also going to follow suit. They're going to project these companies to have lower earnings for the year, and that price targets are going to go down. And when they start doing this for all the different companies, suddenly these forecasts also go down because we've compressed the multiple so far, but we have not compressed the earnings essentially. And so at the end of the day, we're talking about ETFs and what's going on with maybe your portfolio and what you can expect. I think that there is some potential downward movement still to come in the market. But at the same time, be wary of something like this. Don't compare yourself to other people that might have invested in energy sector ETFs. Don't compare yourself to what you used to be and what you used to make in returns over the past few years. Don't do that. Just say, I'm going to keep a diversified portfolio of good stocks, ETFs, index funds, bonds, whatever it is that you invest in. It's got to be a diversified, risk-adjusted portfolio. Don't take too much risk. And I think over time, if you continue buying as the market goes down, I do think many people are going to look back at this time period and say, man, I am so glad that I added money into the market still. No matter what's going on, if semiconductor supply is increasing, if there's suddenly tons of inventory, if the PE ratios are compressed and then earnings are going to get hit soon, all of this stuff, if you keep investing, I do think that this is going to end up being a good time when we look back over many years from now. So that's all I have. I hope you liked this video. If you did, please hit that like button, subscribe to see more videos like this. And I got another video coming up on the end screen. Please watch that right now.